So it is a beautiful day here. We're in Rancho Mirage, California, about 75 degrees. The sun is out. I'm here with my good friend Enrique. We're at Cotino, the Disney development here in Rancho Mirage, and we're going to hopefully be able to take a look at some of the houses here, and you can kind of see some of the houses. That one right there, they're putting up right there. A lot of lots being graded. There's homes way in the back there. The streets are in, the sewers are in. It's a huge, huge development. This is over 800 acres. These homes are starting out, I think, roughly around $2 million. We'll try to get some pricing here in a second. But before we get into what's happening here at Cotino, I wanted to just talk about a couple articles I was reading today and a comment that I saw on social media. Somebody commented on somebody's comment on social media questioning a video that I did. I think the video was yesterday about, we're not looking to be in a recession when we're already in a recession. And this individual said, well, how can we be in a recession if GDP is 3.1% and unemployment is 4.2%? And I'm going to answer that this way. First off, GDP at 3.1%, well, let's be very, very clear. They're including all that money that is being sent over to Ukraine. That includes munitions, that's including F-16s, that's including the checks, the cash of multi-billions of dollars, weaponry, all that all gets included in the GDP. So if you look at that, GDP is doing very, very well because we're spending a lot in many, many wars. That war, we're spending money over in the Middle East, we're spending money all over the world. So that is why the GDP is 3.1%. If you erased that, the GDP would probably be negative at this point. When we talk about unemployment being at 4.2%, how many people out there actually believe that the real unemployment is 4.2%? First off, they don't include people coming out of college. They don't include independent contractors. They don't include people who've lost their job. And they're certainly not including the people who lost a job and now are working 2 and 3 jobs to make up for that one job. So, to people who question stuff like this, stop believing all the manipulated data. The numbers are so skewed. That's like saying that you believe inflation is 2.6%. You are drinking the Kool-Aid if you believe inflation is 2.6%. If you believe that the US dollar is not under extreme pressure, that if you believe the US dollar is actually strong today, well, yeah, it's strong compared to all the other weak currencies, but we've lost 98% of our purchasing power with the US dollar. So, really think about where we're at and how many people are actually believing the data now. Any thoughts on, people actually believing the inflation numbers, the housing numbers, the GDP numbers, the unemployment numbers, all this? Remember, inflation was transitory. I mean, these numbers are completely a big joke.
Yeah, well, the thing is you do have to remember too that nowadays there's a lot of manipulated information out there online. So you do have to do your due diligence. Don't just take one source of media and say, okay, that is what it is. Dig deeper.
Right.
There's a lot of different sources out there that'll give you more data, especially on YouTube nowadays. I feel like that's a very good source as well. There's a lot of people that do a lot of deep dives when it comes to real unemployment numbers, when it comes to the GDP. And then also, you could see it in real life, how much things have gone up as well. So just because you're hearing it doesn't mean that that's reality.
So that's like when we're being told for 4 years that the economy's booming, everything's great, yet people are losing their jobs, mass layoffs. We see all day. You and I go out weekly and we see the vacant buildings, the businesses that have been lost, all that stuff. So they can tell you one thing, but in the real world where we live, it's not looking too good.
Yeah, the only thing is it's a very small sector of the economy, or there's certain pockets in the United States that maybe that data does reflect it, but for the majority of the United States or the majority of the population here, they're struggling. And you can see that people's comments. If you look through the comment section on JB's or even my videos, you will see that a lot of people are struggling. They're having real world problems that do not reflect what they are telling you in the media.
Make sure you go to Enrique's channel. Enrique Reacts. You dropping a show tonight?
Tonight,
What,
yes.
what are you going to be talking
Spending
about?
addiction.
Spending addiction.
Spending addiction. Go watch it. I think there's a lot of things that people can do right now to make themselves better, especially right now as we're entering a new year. A lot of people have a lot of New Year's resolutions. And one of the things that we highly say all the time is if you're going to start something, don't quit. Keep at it. Keep doing it. Repetition is key to be able to reach your goals, not only financially, but then also when it comes to family, you want to make sure you also pay attention to them. Don't, go ahead and let that go as well.
Very, very good. CNBC, we talked about this a couple days ago. Mortgage demand dives nearly 22% to end 2024. So we're here at this development, multi-million-dollar development. It's huge, and they've got a lot of money invested here. For the 2 weeks ended December 27th of 2024, compared with the week before, down 22%. Refis. Applications for refis fell 36%. So applications to purchase a home, mortgage applications have fallen 13% from this year to last year, or from last year, down 13%. That is a substantial number, being down 13% this year compared to last year. What are your thoughts when you look at a development that is just massive here, over 800 acres, Disneyland?
Yeah, it's very difficult for people to be able to afford this. Even people that have high net worths or people that have a massive amount of savings, even those people, it's hard. It's getting harder for them to justify to be able to purchase these types of properties. You may have some individuals that are probably not even from this country that are investing, that maybe they want to go ahead and purchase a property and park their money. But even then, it's getting more difficult, and the amount of buyers that are willing to take a risk and a gamble on something like this, it's decreasing. That's the reason why you see less demand overall for these types of things. Maybe there's a lot of people that want to come and take a look at it. Maybe it's their dream one day to be able to purchase these. But how many of those people, how many of those looky-loos coming into these offices are actually going to make the purchase?
Right.
It's going to be a very small percentage. And I even talked to someone earlier today that actually has ties to this place. And what she's telling me is that, yes, there's a lot of people looking. But what she didn't tell me is how many people are actually putting the down payment and actually making the purchase, right? That number is actually very, very small.
When they started breaking ground here, mortgage rates were not 7%. And today, 30-year is 6.95%. So we might as well just say 7%. This is critical. And so if we see things tick up to 7.25%, 7.5%, 8%, that could be catastrophic for even a development like this.
Oh yeah, for sure. You have to remember that actually 7%, it might sound like a small number, but over time, over 30 years, that's a lot of money.
At $1 million plus.
If you're talking about $1 million after it's all said and done, that's a massive amount. So even if you held the property on for a certain amount of years and you did sell it, you may think you got a profit, but if after all the interest that was paid and all the upkeep and the HOAs, which I'm pretty sure that the HOAs here, I mean, what are they going to run? Maybe over $1,000 a month? Who knows? So
easy.
That's money that is actually, you will never see it again. And so when you sell the home, all you're doing is you're just recouping all that money that you paid out.
So listings ticked up with 22% more homes for sale in December compared to last December.
Yeah.
Don't you think that people, even in a development like this, are getting a little bit nervous with mortgage rates been ticking up 100 basis points since they began cutting rates?
Oh, for
and
sure.
Now listings piling up, 871,600 plus active listings now in America. And we're talking about a very, very high-end development here where you have a very, very few people that can purchase a home like this. And people that can purchase a home at this level, they're pretty savvy. They start getting a little nervous. They're not going to be spending money.
Yeah. Well, the thing is people that have this type of money, they have people that are overseeing it as well. So usually it's not just them. For the most part, they also have financial advisors and other people that know about finances. But even then, the amount of people that have the type of money to be able to purchase these properties, it's a very, very small amount. And even then, even if these things get sold out, how many of these properties are going to be able to be resold in the future? Or how many of these people are going to fall behind on their HOAs? this economy is very fragile. So even if you do purchase a property like this, it doesn't mean that you can afford it, right? There's a lot of people that are purchasing high-end vehicles and high-end homes, and within a couple months, they're already falling behind because they cannot afford it.
Yeah, so it's a bad combination. You have homes at all-time highs, and you have mortgage rates at 7%, a number we have not seen in many, many years. So it's a bad combination, and I think people are overpaying for homes right now. And at 7%, which is a normal rate, don't get me wrong, but it's not normal when you have, $300,000 homes selling for $700,000. That's not normal. When you have homes going up $100,000, in a year, that's not normal. So it's going to be very interesting to see how this plays out. And this reminds me so much of 2006-07, where we would see these massive developments, these high-end developments start. A couple homes would go up, handful of homes, maybe 100 homes would go up, and then all of a sudden everything came to a dead stop. And it was nothing but tumbleweeds, and the lots sat for years before any life ever came back into these developments. I'm not saying that's going to happen here, but I would think that there's got to be some people really, really getting a little bit nervous because there's so much money now involved in a development like this. And if something goes wrong with the U.S. economy, the housing market, no doubt, is slowing down. We're looking at the amount of homes that will be sold in 2024 that we just finished. Less homes will have been sold in 2024 than 2008, and they're predicting less homes will be sold in 2025 than 2024. So that's not a good sign if you're sitting on a multi-million-dollar development. I mean, this thing could be $1 billion. I don't know what they have involved in this thing. We're talking, I think, 860 acres, about 2,000 homes, restaurants. I think a hotel is going to be put up here. So this could be, a $1 billion investment. So this can come to a halt literally overnight. And so now with some of the violent acts that are taking place on U.S. soil, we're seeing more volatility in the stock market. We have mortgage rates at 7%. It's not a good combination for what we're seeing here today.
Yeah, it's very difficult to project whether or not this type of project will actually finish. And again, we're in a very fragile economy. We're entering a new era with a different president and a new administration, and anything could change.
Yeah.
The new president could put out certain regulations, or we have the government that can issue new different laws that could affect these types of developments from finishing.
And I will say this, and correct me if I'm wrong, you're coming into a new development like this in this economy, new administration, a lot of things happening. You're taking some risk to come in here and spend $2 million, $3 million, $4 million. You are taking risk because we are in the first stages of this development, and we are on very shaky ground as far as the real estate market, commercial real estate, bond market, stock market, everything overpriced. You're taking some risk as a buyer, wouldn't you? In something like this versus something that's been more established?
Well, yeah. And the thing is in this area, I don't think there's another development that has been actually completed like this. So I don't know where they get their data from. Maybe this reminds me a little bit of Celebration, Florida, where maybe they have other properties that are similar to this. But it's very difficult to project whether or not this is something that is going to be viable on the long term. It just depends on the population and whether or not they're willing to purchase these types of properties and actually stay in them and to be able to bring a community. I'm not sure at these prices it's going to go ahead and flourish.
So we're going to get out of here right now. I'm going to add on tomorrow's video the tour of some of the homes that we looked at today. So I'll put that on tomorrow's video. We toured a few homes, toured the property. Very, very interesting. So if you're interested in seeing the homes, make sure to tune in tomorrow. I'll be adding that to tomorrow's video. Have a great day. God bless. Take care. Enrique, anything in closing?
Stay safe out there. There's a lot of things going on. Make sure you do your due diligence and be prepared.
God bless. Take care. Like Enrique said, be careful out there. Keep your head on a swivel. Situational awareness. A lot to come. Talk to all of you soon.